All investing is subject to market risk, including the loss of principal. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives. This information is provided for illustrative purposes only and is not a prediction, projection, or guarantee of future performance. This podcast is provided for general and educational purposes only and is not intended to constitute legal, tax, securities, or investment advice or recommended course of action in any given situation. All opinions and views constitute our judgments as of the date of production and are subject to change at any time without notice. Welcome back, everybody, to a next Dakota Research Interview. Today, we have a very exciting guest, Matt Miller of Grey Rock Investment Partners. Matt Miller is the founder and managing partner at Grey Rock Investment Partners. He is a member of the investment committee for the firm's Net Zero Opportunities Fund and the investment and valuation committees for the firm's natural resources funds. At Grey Rock, Mr. Miller focuses on deal origination, valuation, due diligence, execution, project management, and divestitures. Mr. Miller serves as co-chairman of the board of directors for Granite Ridge Resources, Inc. Using his expertise in energy ecosystems, Mr. Miller works to ensure that the Grey Rock portfolio maximize return for a given amount of risk. Previously, Mr. Miller worked at McKinsey & Co. and Bluescape Group. Mr. Miller holds a BS in Commerce with distinction from the University of Virginia, and he is a CFA charter holder. Matt, so glad to have you in the Dakota studios today. Thanks for taking the time. You're expert in the energy space, so we really appreciate the insights you're going to share today. I know we've got a lot to cover, both introduction to yourself, also the firm, the investment strategies that you manage today, and then we're going to get into sort of the current opportunity set and the landscape across the investment energy ecosystem. But just to kick things off, can you share your professional background and what led you to founding Grey Rock Investment Partners?
Yeah, absolutely. Thanks so much for having me today. I really appreciate it. Yeah, so we started Grey Rock back in 2013, only 28 years old, so kind of young and dumb, right? But the original thesis for Grey Rock was really oriented towards natural resources, an oil and gas strategy. It was a unique time. You were right in the middle of the shale revolution, and that was a great opportunity for younger entrepreneurs to get their start. And we had a unique investment thesis around an asset class called non-operated working interest, kind of in the weeds, but, sat around a kitchen table, drew up some slides, and we were able to convince some phenomenal LPs to back us. And, kind of the rest is history, been building the firm ever since then.
And how have your experience shaped your investment philosophy at Grey Rock?
I would say that we have the benefit of having access to phenomenal partners in our limited partners. And so they impart a bunch of wisdom to us along the way. You gain some more wisdom along the way through unfortunate scar tissue.
Right.
I've got a great friend of mine who has a phenomenal phrase for this, which is risk is the price you never thought you'd pay. And that bore itself out in COVID with negative $37 oil, and that bears itself out kind of across the investment landscape. And, I would say that some of the wisdom that we've gotten along the way comes from both personal and professional experience, as well as trying to adopt the wisdom of others. That might be reading something, that might be, listening to others that are more educated or have more wisdom than we do. I think, I grew up in a slightly unique fashion. If people are looking at this on video, they see somebody who's reasonably put together, and everything looks like it's super easy, or came easily. But when I was younger, my family didn't have enough money to even afford a place to live. So we actually had houses that we moved into. My father owned a small furniture store, so we staged furniture in these houses, and we moved 13 times in under 3 years. And so I think coming from that to where we are today, I would say it taught me the value of hard work, of stick-to-itiveness, and the ability to succeed from kind of tougher circumstances. It also taught me to be extremely thankful for what we have today. And so kind of all those component pieces, I think, are taken into account when we're building out investment strategies at Grey Rock or hiring people and engaging with our investors.
No, I think the value point that you make is so important to kind of approaching everything with humility and respect, and particularly in the space that you're investing in. It's an environment too, and an asset class where you have to roll up your sleeves and really do the hard work to generate outsized returns. So Can definitely appreciate and thanks for sharing that too. Um, Grey Rock Investment Partners, been around for a long time, established firm. Can you provide a brief overview for our audience just on the firm, its core mission?
Yeah, absolutely. So Grey Rock, we're an energy private equity fund. I mean, we're energy specialists at its core. We manage about $1.5 billion of equity capital across our platform. We really have two legs of the investment stool. We have a natural resources strategy. So that's code for oil and gas or traditional energy. On that side of the shop, we also control a public company called Granite Ridge. So I co-chair the board of the Granite Ridge. We have 5 natural resources funds. We also have a net zero strategy, so a low carbon strategy. You know, I joke around that, you know, I'm the guy on Canal Street selling energy Rolexes. Which one do you want? You want carbon or no carbon? I got to, you know, kind of talk to both sets of investors. Really, what are we doing for our partners? I'd argue we, at its core, we're trying to demystify energy for people. Energy is a little bit like pharma. You know, it's not a place for tourists. And if you're a tourist in this space, you do have the potential to be taken advantage of. You know, there's an old adage, you know, when the oil man came to town, he had all the knowledge and I had all the money. And when he left town, I had all the knowledge and he had all the money. And we're trying to rectify things like that within the energy ecosystem on traditional natural resources. On low carbon, I think it's trying to help investors think through how complex that ecosystem is. If you think about it from an LP's perspective, everything that crosses their desk is going to have a giant sustainable, you know, label on it. You know, I'm a green debt fund. I'm a sustainable credit fund. You know, that's really hard for LPs to sort out who's telling me the truth, to separate the wheat from the chaff. Is hydrogen real or not real? Is nuclear fusion real or not real? You know, walk me through all these things. And what we really try to do at its core for our investors and our potential investors is just to try to demystify these systems, to talk through some of that complexity and say, hey, you know, here's a little bit of signal inside of all the noise, right? And as you can imagine, in today's environment and political environment, there's an enormous amount of noise, and we're trying to help people kind of see through that. And by the way, make money along the way for them. We still are clearly a fiduciary.
No, it's an incredibly important point too, as well, that you make in both, you know, natural resources aren't going anywhere and they're still a very vital part of the economy, how things work. And but there is a natural evolution too. And in being able to play to that as well, you know, is critical.
The two systems are innately tied. They're innately linked. Energy is a place of just a ton of butterfly effects. If I tap on one part of the ecosystem, it ripples through to other parts. You know, people call that the second layer of the onion, or however you want to think about it. And I try to use simple examples for people on hey, you may do one thing and you may affect a system in a weird way, right? So a good example might be Europe, right? In the North Sea, the UK built out a lot of wind resource. Okay, so a lot of wind power. And there's a phenomenon that the Germans have a weird word for, Dunkelflaut, you know, that means, hey, the wind's not blowing in essence. And so what happened, and this is a couple of years ago, but this has been happening seasonally, is when the wind power is not there, people need 24/7 electricity in a developed economy. You know, you just can't have grocery stores and hospitals and businesses shut off power. And so what happens is, you know, natural gas prices go up because new natural gas demand is there to power their economy. And so we've seen European natural gas prices go up to about $30 an MCF. Just don't even worry about the units, just $30 a unit. For some sense of scale on an energy equivalent basis, that's a $180 barrel of oil equivalent. That's a very high price, very high price. And so what happened in this Dunkelflaut system was, you know, the UK started importing very expensive natural gas from the Middle East. The Middle East started burning crude oil in its power plants, much dirtier, right? So by virtue of trying to build out clean energy resource in the North Sea, we randomly increase carbon emissions somewhere else, thousands of miles away. And so that's just like a really simple example of how these systems are linked, and they're very complex. And if you don't think about, to butcher the Wayne Gretzky, where the hockey puck is going and skating there, you can get really burned pretty quickly.
So Gray Rock, you're based in Dallas, Texas. You're in right in the middle of it. When you think about the firm and how you're set up, what sets you apart from other energy specialists, energy focused investment firms?
Yeah, I think that's a great question. So we really do think about the energy system holistically. Each quarter we put out, quarterly letters for our partners and friends. And I might call those more thought pieces than, obviously we have a supplement to our letter that says, here's how your investments are doing, but more along the lines of trying to think through what's going on in the energy ecosystem right now and how can I think about that. And I think that provides a lot of value, provides a lot of insight for investors. That being said, we are truly in this energy world, and it's a small world. So we're also not the style of GP or fund that says, hey, we're the only place your dollar can go. If somebody calls me on a reference on another manager, I had one yesterday where I openly said, those guys are money makers, and I don't think you can go wrong giving them some money because we don't think about the world in a zero-sum way. I think a place of expertise is really what you're looking for in energy from a manager. I also think you're looking for an earnestness and an honesty. Sometimes things aren't going to go great. When Silicon Valley Bank happened, I was emailing our investors within an hour of that, just saying, here's our exposure, here's what's going on, here's what I know right now, because more information is better than less in a scenario like that. Really, I think that's what we try to do is set ourselves apart as a true partner to limited partners and investors, as opposed to something like an asset allocator or, fee gatherer or something along those lines.
And you mentioned too the educational component too, and from an organizational perspective too, like the team, how you're set up, where you're based, just being an added advantage to there.
Yeah, I don't know if you've read this, but Texas is growing pretty quickly. So we actually have the benefit of a lot of great talent coming to Texas from all over the country. It's a really vibrant place to be right now, especially for young entrepreneurs. It's a truly meritocratic place. One of the things that I think we've done really well at Grey Rock, if I was a hedge fund and I was talking to you about what's our edge is our people. It really is. No doubt. It's our people. And so we have about 35 folks on staff. And how do we find creative folks with tons of intellectual horsepower and align them? And I think we have a great process for finding those folks. We actually use a case study process. Okay. So I started at McKinsey. My co-managing partner started at Bain. So blame the consulting mindset. But I use the example of lawyers. If you're interviewing for an attorney to join your staff as a senior counsel or whatnot, every attorney sounds great. They're all very educated. They have glistening resumes. They have perfect references. They're all coming from big firms. They're coming from Vincent and Elkins and Kirkland and Haynes and Boone and whatnot. How do you tell who's a good attorney and who's not going to be a good attorney in that chair? That's actually quite hard to do with just a verbal, hey, because at that point you're really judging somebody on their vibes, And so what we do is we give a case study and we say, okay, here's a term sheet, something we've agreed to, a hypothetical term sheet that we've agreed to with a counterparty. And here's an LLC agreement. And I want you to mark them up. I want you to give me a red line. And I want you to comment for me on these agreements. And so table stakes for an attorney is just, hey, inside of this LLC agreement, it says the definition of annual budget is an 8.3B. And hey, there is no section 8.3B, right? Okay, that's table stakes, right, for an attorney. But really what you want is somebody who's going to be a thought partner with you over the years. They say something like, in that annual budgeting process, you and your counterparty, you've created an incentive for them not to be aligned with you over time, or something that's a second order level of thought. Because, checking box number one, I don't want to have to check your work. Do you know about checking the definition section of an LLC agreement? But also section number two is, hey, I'm a thought partner here. And that's really what we've been able to build through the years. And so we do that on a landman role. Every landman's going to say they're great at Excel. phenomenal. Here's a question. I want your answer in a pivot table, and you watch a landman's head explode, right? And everything in between. And so it's truly just a rite of passage around here. And we've been able to identify phenomenal talent, and it also removes bias, right? It really does. You may think, hey, that's a Harvard law or a, Yale law or something along those lines versus I won't use a school name. I'll use Georgia. I'm from Athens, Georgia. Let's see. That's a Georgia law kid, and sometimes that Georgia law kid is smarter, better, more of a thought partner than some Ivy League school, and that helps us remove bias on kind of each candidate as well. So that's just something that we truly view as a strategic competitive advantage as we're in this growing competitive environment.
I'd like to turn to the investment strategy that Grey Rock offers today or invests out of. Could you kind of take down like another level too, just for each strategies, walk me through those strategies at a high level?
There's two overarching energy theses here. And it's going to sound like I'm talking out of both sides of my mouth. So bear with me. Bear with me. But the first is we think oil prices are off to the races within the next several years. And even if you're not an oil and gas investor, you need to know this because this will impact inflation. And you need to know that with your inflation hat on. And I'll walk through that in some detail. And the second piece is the drumbeat of carbon is only going to get louder in our lifetimes. Climate change is real, and young people put climate in their top list of issues. That means policy is headed our way. And I'll walk through that as well and how we play that. So on the first piece, in terms of energy, we make US-based upstream investments. We do it in two different ways. So we back operated teams, and that's where we own control over an asset. That's something akin to what you might get with an NCAP, NGP Quantum, but at a kind of lower mid-market scale. Kind of think of us more in that Pearl Carnelian space. We also do a deal style called non-op, which is oversimplifying here, but we might own 10 or 20% of a project that's drilled by somebody like an EOG or a Diamondback or Conoco or something along those lines. And our goal on the traditional energy side is to be your one-stop shop for energy. It is to create for you something like an energy ETF. It's diversified in terms of basins. It's diversified in terms of hydrocarbons. It's diversified in terms of operators. It's not high on the debt scale. It's high on the yield scale. And ultimately, the overarching thesis over there that we're talking about in this oil piece is this. We think that the world has lulled itself into a soft slumber on the back of US shale oil. Okay, so in the past 25 years, the world has moved from about 75 million barrels a day of oil consumption to about a little over 100 million barrels a day of oil consumption. The thing that fed that growth came from the United States. Okay, so people don't know this, but the United States grew an entire Saudi Arabia of oil production. Not like, hey, we produce as much as Saudi. We produce more oil than any country in the history of humankind. We grew a Saudi. Where did that oil come from? It came from shale. So shale production moved from about 5% of our production to about 80% of our US production today. Okay, why does that matter? I've read about the shale revolution. Who cares? That's great news. That's great news. We're an energy powerhouse, right? Well, here's the thing about shale wells. Shale wells decline at twice the rate of traditional conventional wells. So things like wells in the Gulf of Mexico or the North Sea. Honestly, not a problem yet. So far, so good. And they're not declining in a way that we didn't understand petrophysically. These are still economic wells. The industry calls them short cycle. The issue that we're running into is we're running out of it. we're draining this shale resource much faster than people think. Scott Sheffield was at CERAWeek this week and openly said, hey, we sold Pioneer to Exxon because we thought we were running out of tier 1 inventory. Think of that as your grade A inventory in the next 3 years. And we thought we were out of tier 2 by early 2030s. That's going to be here faster than investors understand. Okay. And so it's just when you look at the sticks on a map, which are horizontal wells on a map, there's not virgin rock out there that we really see. And we think that the United States is going to disappoint global demand in the same way Hemingway went bankrupt, gradually and then all of a sudden, because of that decline profile. And so if you think about that with your investor hat on, in the next 5 years, you may see materially higher oil prices. And you may say, well, who cares, right? Because there's be substitutes for this stuff. And I've read about wind and solar. No. You're thinking about this wrong. Wind and solar are not substitutes for oil. Oil is a transportation fuel, and it makes things like plastics and petrochemicals, fertilizers, etc., right? It's not what we use to power electricity. It just isn't. And when you think about, well, I've read about Tesla, we're going to electrify all this other stuff. Trust me, you are not electrifying airplanes. You are not electrifying trains. You are not electrifying cargo ships. You are not electrifying Class 8 trucks. You're not electrifying 18-wheelers. These things are different kinetic energy systems. And also, when you think about that world of substitutes, what we tell people is, hey, if you want to think about a world that's all hydrogen airplanes and all electric vehicles, you've actually already lived in it. You just didn't realize it was happening while you lived in it. And what we point investors to is in May of 2020, that is the absolute depths of COVID. No airplanes were in the sky. No cruise ships were on the ocean. None of us were going to work. We were all inside of our houses, right? You know that oil prices went negative. Like it was a disaster for oil. And what we say is, what do you think demand for oil was down just that month, just that crazy, crazy month that we all lived through? Do you think it was 50% to cause that or 70% to cause that? No, oil demand was only down 10% that month, 10%. And so that's just an example of like oil is in every human product imaginable. It's, as I look at my background, it's in these carpet fibers. It's in the polish on this chair. It's in that picture frame. It's definitely in these windows. It's in my glasses. It's in everything. It's in your toothpaste in the morning. And I just don't think people realize how omnipresent, and there are no real substitutes for it. Okay, so that's kind of traditional energy in a nutshell. And that's why we do that, is to provide investors that high yield inflation hedge. Now let's talk low carbon. And it may sound crazy that we're able to reconcile this inside of one head, right? I totally understand. It's weird for me to say that and then say something like, yeah, climate change is real. I think, people find that incongruous, and we don't. And so there's a couple of things I'd point out on the low carbon side of the world. We have a net zero opportunities fund where we invest in things like carbon capture, electrification, methane abatement. You could think about us as being a hybrid of real assets and private equity trying to impact that carbon molecule.
And these aren't very new technologies, or are they?
No, great question. We are not your venture capitalist.
Right.
We heartily encourage you to hire Bill Gates to do that for you. We are not traditional energy folks that now say, hey, I met this MIT physicist and I swear to God, this membrane is going to work. I'm not qualified to do that for you. I can point you to some guys that I think might be interesting to talk to about stuff like that. But we are trying to be more in the steel and cement impacting emissions business. You can think about that as, decarbonizing old plants and building new plants in terms of oversimplifying how that works. But I point people to, if you think we're in a new era because Trump got elected, right? I got a call yesterday about that from a New York-based LP. Are things different? And what I tell them is, hey, let me just give you an anecdotal example of why I'm convicted on this. So I went to the University of Virginia for undergrad. There's a picture of Charlottesville right behind me. And I went to the Commerce School. I was a finance dude. I worked at McKinsey, right? I did the tried and true path. I could have gone in investment banking or consulting or whatever. And there's a bunch of kids that do that. Now you have to realize that the kids who go to the Commerce School are not evangelists on climate. These are not your enviro-sci kids, right? These are the folks that are going to work at Blackstone and Goldman and McKinsey and whatnot. These are realists, and these folks want to make money over time. I took 10 of these kids out to dinner not too long ago, and 7 of the 10 were concerned about having children in their lifetimes linked to climate change. That was eye-opening for me in terms of, hey, first off, having children is a good and valuable activity, and I highly recommend it. It's life-changing. And also, part number 2, I think humanity is way more adaptable than they're giving credit for. But I point that anecdote out to people to say, hey, you may say that these kids are brainwashed, or you may use weird rhetoric for that. But I tell people that's the future of the Republican Party. And I tell you what, these kids are not going to be saying in 5 years, when Trump is 90 years old, by the way, is climate change is fake. They're not going to be saying that. They're going to be saying climate change is real and we need to have reasonable policy against it. And so when you add 50% of the country is Democrat and definitely believes in climate change, you only need 50%, less than 50% of the Republican Party to be passionate about this, to have a constitutional supermajority against carbon. And that's where we're headed in the next 20 years. The SEC has already come out with, here's how we're going to measure your scope 1, scope 2, scope 3 emissions, right? Why do governments measure anything ever? Taxes. Taxes. Why is there a Bureau of Weights and Measures, right, in the United Kingdom? It's taxes, okay? And that's where this ecosystem's headed. Carbon will have a price. Carbon will be an ecosystem that rivals traditional energy in terms of scope and scale. It will rival oil in terms of the scale of the marketplace. We are in very early innings of this. And because you're in very early innings, you're going to see money get torched. You're going to see investors getting taken advantage of. There's charlatans. You're going to see hype. You're going to see hype followed by nadirs of panic and everything in between, in any ecosystem that eventually gets regulated over time. And so that's really what we try to do, is we try to be a little bit of a North Star for investors who want to have an impact on carbon, but say something akin to be clear, I want to impact carbon. I am not a charity. I'm hiring you to be my private equity manager and deliver to me competitive, mid-20s to mid-30s net. I want you to figure out how to do that. That's a tough challenge, and I think we're able to do it. And I think that's why we get hired.
For each of those strategies, you mentioned the 20 to 30%, but so for the return profiles for resources and then low carbon, what are those exactly? When I think low carbon too, is there any sort of return degradation, or do you get it seeking like a lower return profile?
Yeah, great question. So, they're both in the 20s to 30s net and 2s to 3s net. Each deal is going to vary in and around those numbers. But that's really what you're hiring us to be competitive with what you might get at an LBO, private equity return. We would rather be lumped into a private equity bucket than lumped into a low return infra bucket in terms of the capital. And on the low carbon side, we like I mentioned, we don't have a charitable cost of capital. There's no community adjusted EBITDA here. These are cash on cash returns. So we have kind of 3 verticals right now that we're active in. One is carbon capture, one is electrification, one is methane abatement. And in each one of those verticals, we're able to deliver those returns while having a material impact on carbon.
When you think about risk, so you mentioned kind of volatility in oil prices against kind of backdrops throughout cycles, but can you explain Grey Rock's approach to managing risk while targeting high returns?
Yeah, great question. So on the traditional natural resources side, the way that you manage risk is first, items 1 through 100, don't borrow too much money. The oil man loves debt for some reason. And I don't know how many times traditional energy people need to learn this lesson, but we have a phrase for it around here. Your banker's your best friend till he's your worst enemy. So try to stay friends with your banker. Okay. So first off, don't borrow too much money. What does that look like in terms of a target metric? I might think about that as being, up to 1 times EBITDA of debt. You're usually pretty safe, because then you can layer on top of that hedges, right? What is a hedge? It just means I'm going to lock in my commodity prices typically for about 24 months on a go forward basis. So, right now, publicly available information, so I'm not doing MMPI here, but Granite Ridge, our public company, is hedged on 90% of its production for the next couple of years. So that's kind of over there how we think about it. Obviously, when we're going into a new deal, that deal involves drilling and development. We have reservoir engineering staff that are going to look at, these are professional rock jocks, and they're going to be looking at how do these rocks perform under different commodity price scenarios: low gas prices, low oil prices, high capex, right? Where does this deal break or not break? And so you got to be very proactive about risk management at time of asset entry, and then also at time of asset management is kind of how I'd think about it. On the low carbon side, kind of a different beast altogether. Let's pick on carbon capture here. So how do you get paid to do carbon capture? It's through a tax credit. You get paid through a tax credit. The tax credit has a very weird name. It's called 45Q. Okay. And 45Q got a lot of press when the IRA happened. It got a lot of press, and Biden and Manchin passed this bill, the IRA, and it's just a big climate legislation. Well, what nobody said out loud is, hey, 45Q was actually created under George W. Bush. This is actually a Republican created thing. And then basically, long story short, under Bush, we passed this tax credit. We, the United States, passed this tax credit at $20 per ton of carbon dioxide. Long story short, that's too low of a price to do carbon capture with. It got enhanced in price under a 2018 bill to $50 a ton. You know who did that? Donald J. Trump. What a weird thing. I wouldn't think about those two guys as being, advocates for the environment, but here we are. They created this law and then enhanced the price, and then Biden enhanced the price again. Why do I bring that up in this risk conversation? It's because in some of these low carbon investments, like carbon capture, if you're going to be relying on a tax credit or a tax regime or something along those lines, you inherently need to know the political end of this. You have become a little bit of a defense contractor. You're a little bit Lockheed and you're a little bit Boeing. So you need to know a little bit about DC and what's going on. And we've been able to be reasonably well connected within those ecosystems to understand, hey, of all the possible energy transition tax credits out there, 45Q was the safest. It was the safest. And this was part of our diligence and part of our research to say how, because you have a weird risk here. It's binary risk. If this tax credit goes away, you don't have a business. I don't like that risk at all. So how do you get comfortable with that? Well, you do more research and you find out, okay, well, actually there's a safe harbor provision. So if it costs you $100 to build a plant, and you spend $5, the first $5, and then they repeal the law after that, you are grandfathered in to the law, right? And so we talked to a constitutional law expert and said, why is that? What is a safe harbor provision? And he basically gave us a kind of unique way of thinking about this. He said, if governments can retroactively change laws, then no law could ever be trusted ever. And the example he gave us is, imagine how many people are in jail right now on marijuana offenses in states where marijuana is currently legal. And it was because it was illegal when you did it, not because it's not okay now. It's kind of a weird concept, but that was kind of, oh, that makes sense. And then we dug in more on carbon capture and started to understand, hey, look, carbon capture in terms of making private equity economics, not really applicable to coal plants. Why? I thought this was what the whole fight was over coal. Well, Coal's not a good place for us as investors. You got to think with two different hats. You got to think with your investor hat on, not your what's good for humanity hat necessarily, but more like, hey, if I'm an investor, what am I going to make money in? And coal's not great for carbon capture because when I burn coal for power, I emit CO2, but it's only 10% of the emission stream. And so I got to put a very special sponge on the back end of a coal plant, high CapEx, high OpEx, plant downtime, et cetera. The plants that make money in carbon capture are the ones that emit pure CO2, okay? And those are natural gas processing, ammonia, which are fertilizer plants. And this is the critical one, ethanol plants. Why does that matter? Why is ethanol critical? Well, if you think with your politics hat on, ethanol emits pure CO2. These are highly economic carbon capture projects. At the project level, you're talking about mid threes to almost 6 times your money unlevered, great project level returns. The reason why that's important is now you've made allies of not only the energy lobby, but also the farm lobby for ethanol, which makes 45Q very safe politically. We were actually able to talk to a couple former speakers of the House about this personally. So to kind of confirm how we were thinking about it, there's an old quote by Milton Friedman where he said, there's nothing quite so permanent as a temporary government program. And that's kind of where we landed on 45Q, is just to say, hey, this is a great way to make money. It's resilient. It is positive impact on carbon, but it's also not, it's using current technology. To your point earlier, the carbon capture we're talking about is technology that was invented 50 years ago in traditional energy, in oil and gas. It's not something like nuclear fusion that's just way out there. And so that's a very long-winded way to say, yeah, we think about risk a lot when we plan out downsides a lot, and that's at the investment level. And then ultimately, if you do it right at the investment level, at the fund level, you're fine.
Maybe this is part of a further risk conversation too, but data is such a big component too. Just thinking about, the data you're receiving from specific wells, looking at news site data, the engineering, and then on the low carbon side too. Could you just talk to me about data and how important it is for the firm, how that might mitigate risk too as well, but just how important data is for the firm?
So on the traditional energy side, we own an interest in over 3,000 wells, about 3,500 wells. If I wasn't in Dallas and I was on Sand Hill Road, I would be talking to you about our data lake, right? I've got private information, proprietary information on thousands of horizontal wells. That's across 6 different basins of the United States. That's the Permian Basin, Utica Shale, Haynesville, Eagle Ford, Bakken, DJ, et cetera. Like, we know an awful lot. And what do you know when you have that information? Well, I know things like, what is the netback oil and gas price? Does an operator have good or bad midstream contracts? I know what that operator's OpEx looks like. I know what their CapEx looks like per well. I know how long does it take for an operator to spud a well, start drilling it, versus when do I start receiving revenues? Is that 3 months later? Is that 9 months later? Is that 2 years later? This may sound crazy, but you also know production information. So one of the things that people don't realize is, let's say you were evaluating whether or not to buy a well in Texas or a drilling project. And so you pull offsetting horizontal well results from Enverus or IHS, which are kind of the 2 market leaders for production information. Those are algorithms that are making guesses at what wells produce. That might sound really weird, but it's because operators only have to report production to the regulatory authorities on a lease basis. So if you have a lease as it relates to a ranch, and that ranch has 10 wells on it, and 5 of the wells were drilled in 2015, and 5 of the wells were drilled in 2022, that operator only reports one number to the Railroad Commission. And Drilling Info, Enverus, is trying to guess at what are those original 5 wells doing, and what is each one of the new 5 wells doing. It's a guess. And if you look at it, those guesses can be off by like 30%. So without this private information, you can really stub your toe in traditional energy. It's kind of a weird, not well understood thing. So we have a centralized data repository. We've got a Spotfire overlay, visualizations. We've got systems that talk to each other in real time. You can imagine that we have a reservoir engineering system that talks to our land system, that talks to our accounting system. Are we getting paid in accounting what our contracts in the courthouse say we should be getting paid? Is that what is being assumed in our reservoir engineering databases that then feeds into a banking facility? Is the bank loaning us the appropriate amount of money? Having what I might call automated flags. You can think about this as a use of AI, right? If you wanted to get really cute on it, you could use, so to say, hey, there's a well and the net back oil price on that well went $20 in a weird direction. It highlights for our team to say, somebody should call the operator and figure out what happened on that well.
Yeah, super important too. Point that you make too, and all those systems that talk to each other, and having the scale that your firm has too, and all that data feeding through it on a real time basis. And also how you're thinking about kind of new investment opportunities as well.
Yeah, and then, look, on the low carbon side, right? Conduit is our portfolio company that does distributed generation, and its CEO, has a master's in data science from Cornell, Yale undergrad, and right. This is not a dummy, Matt Herpick. He's like one of my closest friends, and he's an amazing and amazing guy when it comes to data science, and has built from the ground up node by node power pricing models with 15-minute increments across entire grid systems. A node you can think of as being a real estate street corner within a grid system. So there isn't just one power price. There's really nodal power prices. And what that team is looking for are things where those nodes have excess volatility because we can ramp up and down power, right? We use hybrid systems. So you've got some battery components, some decarbonized natural gas component, and you can optimize which nodes you're playing at. It's an amazing business. It's a very cool business, but that's an example of us taking that same mindset to the low carbon world and saying, hey, let's dive into the weeds. Let's build a system that's able to take advantage of some information flow that we have.
In today's environment, one of the big topics that everyone's discussing is just around distributions back to investors, DPI. And I know Grey Rock has had a really strong track record with respect to distributions and performance in previous funds. Like, how have you achieved this? I know just on the upstream side, there's, once wells up, there's income producing assets, but just talk to me about DPI.
The way I think about this is what we always say to LPs is, I work for you. You're the boss, not me. I work for you. And so you tell me kind of what your aims and what your goals are. And DPI is always in that top list of considerations, within reason, if you got a reinvestment opportunity or whatnot. So, Grey Rock has been, the number one, number two DPI MOIC energy fund amongst all kind of traditional energy managers, 2010 to 2020, of funds that started in that time frame. And it has to do with, hey, we didn't bite off a lot of risk, right? That old conversation we just had where it's, hey, we didn't get ourselves, we were able to play offense when the tide went out, right? And we lived through collapses in 2014, 2016, and 2020. And the lowest returning fund, our fund one, lived through all three of those collapses and still it's been fully distributed as 1.5 times those investors' money. So our lowest DPI fully realized fund is 1.5 times. Fund two is 2 times. It sounds cheesy, but it truly is like, hey, get rich slow. Don't make big splashy transactions. Don't do something. Candidly, don't listen to investment bankers, as well. And so that's really how we've focused on cash returns. I mentioned to you carbon capture, for example, and these are great businesses. I actually think we'll be able to sell our carbon capture portfolio company vault for a lot more than the intrinsic value of the enterprise. Why? Well, despite the fact that we raised money in the energy transition, I'd argue there's way too much money in the energy transition. It just is concentrated in the hands of mega funds that have $20 billion plus. They have ticking time bombs of investment periods. we have one of the, we're going to have one of the only EBITDA positive, companies that you could invest billions of dollars into and get multiples on that billions of dollars back. It's not that we be taking advantage of our counterparty, but they see we are a seedling for that infra ecosystem, or the energy transition infra ecosystem. But what I tell investors always is, if I'm wrong about that exit, if I'm wrong and we just hold vault and we just do its projects at these ethanol plants, gosh, these are great cash on cash returns. And that's a classic Grey Rock business. Like, we don't plan around an exit. We plan around operating a business. And if you keep that mindset, I had a professor who had a great phrase for this, which is great non-financial performance always precedes great financial performance. And so that's really kind of how we think about getting DPI back, is operate these businesses well, align employees. That case study process that we use at the fund level at Grey Rock, we push down to those portfolio companies. Let's keep that discipline, because that's a great discipline, for example, as well.
Yeah, thank you for sharing that too. And I think it speaks a lot, as you mentioned, about your risk-adjusted approach, value add initiatives once you buy a business, but also buying right, and also having, a fund that's right sized for the opportunity set, cycle adjusted too as well. I'd love to turn to the opportunity set today too. We talked a lot about kind of areas you're focused on at a high level too, but where are you seeing the most attractive opportunities? If specific basins, you mentioned some of the categories too on the low carbon side, but where are the most attractive opportunities that you're seeing today?
Yeah, on the upstream side, I've been telling people, look, you can't swing a dead cat without getting an unlevered 25 to 30% rate of return deal. The reason for that is because investors hate energy, like traditional. They hate fossil fuels. Beware the dreaded, it's different this time. But I do think it's different this time in that, structurally speaking, large pools of capital are just not allowed to make oil and gas investments. So you pick on some obvious names, like CalPERS and CalSTRS aren't coming back, right? And these are large pools of capital, okay? And so for that reason, 10 years ago, I would have been singing a different tune. I would have told you, and I did tell investors, there's too much money in the system. There's too much private equity. There's too much public equity. There was too much debt available. It was really difficult. It was easier to raise the money, and it was difficult to get it done in the deal side, because candidly, managers had too much money at their back and made dumb deals. I think that bore itself out in the data. The inverse is true today. Energy private equity, traditional energy private equity fundraisers are down 90% in the past 10 years. If you are able to do this, then I think it's a phenomenal opportunity set when you think about, hey, right now the forward curve says oil prices are going to be in the low 60s. And if that's true, then our models would point to getting you, mid 20s, net. If what I said earlier is true, hey, shale oil disappoints global demand and oil prices rip, then you're talking about maybe doubling that number or tripling that number in terms of returns. It's an asymmetric upside, we feel like. And then also you got just a ton of wins at the back of natural gas demand. You have LNG, you have AI and data center infrastructure, and kind of those pieces as well. So I think that I think that this is realistically a family office business on traditional energy. They are the ones that can take advantage of this. I do not fault institutions that have taken stances on carbon and cannot do it, just structurally cannot do it. Everybody's got a boss, mine are investors. Theirs are constituents, and those constituents may be students, they may be donors, they may be, however you want to think about it, pensioners, right? Voters, right? And so I don't fault folks for answering to their own bosses either. So it's just a really, really interesting time in traditional energy there. On low carbon, I think the opportunity set in low carbon is where we play, which we've kind of already highlighted. We're not your venture capitalists. And actually, we'd argue, hey, there's too much money in energy transition venture capital. And it's chasing deals that, when we look at it with our just plain Jane energy hat on, we look at things like energy return on energy invested. And some of these venture deals are uphill battles. We saw a deal where a company was taking agricultural waste in California. They were going to heat it up to 900 degrees Celsius. They were going to gasify it. They were going to put that through an engine to make hydrogen and carbon dioxide, sequester the carbon dioxide, use the hydrogen to make electricity to plug into electric trucks. Like, man, what a Rube Goldberg energy project. Like, what a just, gosh, those projects I look at and I'm like, what are we doing as human beings? What a silly, it goes back to the old adage of like, you can have more full employment, if you dig a well with 10,000 guys with shovels than if you use a drilling rig. That kind of feels like what a lot of these energy transition projects look like. And then I'd say that there's, on the infra side, there's a ton of capital and it needs a home. And really what Grey Rock's trying to do is be in between those two. We use current technology, current laws, current customer demand, and we're trying to be the seedlings that those larger enterprises eat. And that's not just the infrastructure funds. That's also national oil companies. Saudi Aramco is on the hunt for this stuff. Equinor in Norway is on the hunt for this stuff. Shell and Exxon and Chevron. But so are the utilities. Duke and Dominion and DTE and Southern Company are on the hunt for companies like that. There's just a lot of demand that if you can create a portfolio company where we are the first 150 to $300 million of equity, we can create a business that then sells for, $1 billion. That other entity sees the opportunity to put an incremental $2 billion into, because we've developed a business development pipeline, and then they invest $3 billion and it's worth $6 billion or $7 billion. And that's how that ecosystem works. So some of those areas I've kind of mentioned, carbon capture, inside of electrification, I think we're bullish on kind of our decarbonized natural gas distributed generation and what we might call hybrid generation business. We're looking at a geothermal deal right now that seems pretty compelling. We've got a methane abatement business that's going really well as well. And so a lot of this is trying not to buy into hype, trying not to buy into hype cycles. Energy transition is a trust but verify business. And so you gotta approach it with a real skeptical lens. We have a lot of the same mindset about these investments that we had in shale 10 years ago, where it's difficult. It's more difficult to find a great deal, but I think we're up to the task, and our initial transactions are looking, pretty salty. They're looking great.
Matt, I'd like to turn to a final closing question for you. For prospective investors, what should they know about Grey Rock's track record and performance expectations?
I'd point investors to, we do what we said we were going to do. And so we've talked a little bit about DPI and a focus on DPI. We've talked about low leverage and a focus on low leverage. We talked about putting the LP first and the LP's interest first as your fiduciary. And that's borne itself out in returns. We've delivered over 2.2 times net TVPI and 1.5 net on a DPI basis. And those are the metrics that we really care about. Don't get me wrong, you gotta consider IRR. I totally get it. I totally get why we gotta consider IRR. But that really to us is success in an industry where a lot of other folks haven't made money, that they've lost a lot of money. And so I think we're off to something really special on our net zero side as well. If you look at our forecasts, it's more likely than not going to beat what we've done in traditional energy. And that's really exciting. That's really, really exciting. And we don't want to count our chickens. And there's I always say, I'll believe it when the docs are signed and the money moves. You know what I mean? But gosh, it is a really cool time to be in energy. I think it deserves a place in investors' portfolios as an inflation hedge, and then also just as a massive secular trend on low carbon as well. So I think it's a phenomenal place for investors to have exposure.
Matt, this has been an incredible conversation. We've covered a lot, both on the current opportunity set, Grey Rock, your background. We really appreciate your time. So thanks for joining us at Dakota.
Yeah, thank you all so much for having me. I really appreciate it.
Wow, we covered a lot today. Thanks to Matt Miller for joining us. Please join us again on our next Dakota Research Interview. We look forward to having you. Have a good day.